History is in the making. The S&P 500 closed for the first time ever above 5,200 as market participants took on risk in what was an upbeat FOMC conference. Yields fell, high beta outperformed, and when you thought it couldn't get any better, the market keeps on coming at you with surprises. So today, we're going to break down the FOMC in detail and what it means for the market looking ahead. We're also going to be talking about earnings. Earnings season for the S&P 500 is nearly over, and it's time we start discussing Q1 earnings because we are only 11 trading days away from Q1 earnings season. So sit back, relax, we've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, and leave a like and a comment for the algorithm. It really helps me out. Cheers. A very green, bullish, dovish day here for the market, guys. When semiconductors participate, we really get outperformance in the Nasdaq 100. Green across the board. I mean in cyclicals, industrials, comm services, even the big boys, Microsoft, Nvidia, Apple, financials, they all participated. The only parts that didn't really participate was this section right here in consumer staples, but growth defensives did do pretty well. Healthcare too, as well as this section here in office REITs, and then energy miners like here, but refineries did do pretty good. All in all, a very bullish day across the board. The sectors that didn't participate were mostly defensive, and we saw a rotation from like these, defensive names. Look at healthcare as well as utilities into just growth sensitive, rate sensitive sectors, as you can see. And that was the call of the town. And that all happened after the FOMC shenanigans. So let's talk FOMC press conference, Jerome Powell. Let's talk monetary policy. So we got the dot plot today. The majority of Fed FOMC participants said 4.5 to 4.8% is where we're going to see Fed funds at the end of 2024. Actually held Fed funds currently at 5.35 to 5.5%. Jerome Powell at his press conference said these things. He said reducing rates too fast could reverse inflation progress. Interest rates are likely at their peak. Unexpected weakness in the labor market could warrant a response. So this is what they're watching right now. If we get unemployment conditions above 4.2% or higher, right, I think that's when the Fed are really going to look at, hey, maybe we should cut rates to not have the labor market get out of control, especially in an election year. Now, they're prepared to keep rates higher for longer if needed. Again, Jerome Powell's been saying all of this stuff every single FOMC press conference, every single FOMC meeting. He comes out and says this. They need greater confidence that inflation is moving to 2%, but it's coming down on a bumpy path. A lot of people were confused by this, but the truth is, yes, inflation is decelerating. We have to look at the longer term data. It is coming down. It is on a bumpy path. Inflation never comes down in a straight line, but it is coming down, and that's what Jerome Powell is looking at. And at his press conference, he didn't seem too fazed about the recent bumps in inflation we saw in January and February. He just seems unfazed. So maybe he's looking at data that we don't see, and that it is going to come down in March and April. He did say the fight against inflation is not over yet, but it's yet to be seen. And something that was really interesting, that balance sheet drawdown taper is coming soon. Again, we kind of knew this, but a lot of the time when the market hears stuff they already knew, but that the Fed hasn't really come out and said, or that Jerome Powell hasn't really stated unequivocally, the market just sees that as dovish. And it's kind of impressive that every speech Jerome Powell gives sort of like loosens liquidity conditions, while the Fed simultaneously is running like the highest policy rate since the early 2000s. Very weird. But we also got economic projections now. Growth expectations from December 2023 to right now, March, actually ticked up. So GDP economic projections is at 2.1%. Unemployment actually ticked down from 4.1% to 4% for 2024. PCE inflation ticked down to 2.4% for 24, and then core PCE inflation ticked up ever so slightly to 2.6. So I think the Fed's saying, hey, rent's looking a bit sticky. We have to improvise our core PCE targets up. And this is why the market rallied right here. I think this was the major reason, in my personal opinion. The Fed pretty much reaffirmed a 4.6% Fed funds for 2024. The market was actually pricing in a 4.8%. And, we were only predicting about 58 points worth of rate cuts for 2024. The Fed reaffirmed at 4.6% for Fed funds, the economic projections. In other words, we're definitely getting 3 cuts for 2024 at 75 basis points minimum, which means that the market had only priced in 2 cuts, and they're rallying on the fact that 3 cuts, 75 basis points worth of cuts are actually coming. Now, looking at 2025, we're looking at a 3.9% Fed funds. So there's going to be like a lot of cutting next year, and then 3.1% in 2026. And then on the longer run, we're looking at about a 2.5% mark here, 2026 and beyond. So this also helped the market market rally, that GDP growth moved significantly higher. That's a 30% increase from the 1.5% mark to the 2.1% mark right here. But all in all, I wouldn't call it a dovish press conference. I wouldn't call it hawkish. I would say Jerome came in neutral. It's just that the market heard what they wanted to hear, what they thought, and these projections came in a little bit more dovish than expected, and the market had priced in less rate cuts, and that's why the market rallied, especially after 2:30 into the end of day, closing at new all-time highs. Now, looking at sectors as a whole, you can actually see, the market was like waiting. It wasn't sure as to what was going to happen. Then at 2:30, Jerome Powell came out, got a whole bunch of data with regards to monetary policy, and then it was up and away. GDX was up 4.13% on the back of gold. Regional banks did really well, metals, mining, home builders, semiconductors. But, it doesn't really matter at this point when you see sectors up 1.4, 1.2, 1.2, 1.19%, 1.1%. When you have outperformance in nearly every sector like this, you're going to all beat the SPY. And the only ones that underperformed the SPY was real estate, staples, utilities. They were still positive for the day, by the way. Energy slightly in the negative 0.14, and then healthcare, the worst performing sector. But yeah, if you were in any sector pretty much today except like energy, healthcare, your portfolio is doing really, really well. And it was kind of crazy to see this type of volatility right here. But gold was probably telling us something like this was coming, because you saw GDX miners right here tick up ever so slightly. So I think a lot of people were like hedging their bets at this point, and it paid off. The market absolutely rallied. Let's hop on the charts. Now, looking at the charts, guys, this is the S&P 500. Look at this green candle. Very, very bullish after yesterday's bullish candle as well. And that was an all-time closing high in the S&P 500. And we just absolutely smashed it up nearly 1% today, 0.89% in the S&P 500, 1.15% in the Nasdaq here. We saw the RSP up 0.85% and another 0.11% in after hours. Nearly a 1% gain for the broader market. This is very, very bullish. And then we had the IWM up nearly 2 percentage points, and the S&P 600 and mid-caps were in the mix as well. I think Bitcoin put up a 10% day. Crazy when you think about that. Gold was up a lot as well. And then the dollar weakened, oil weakened for the most part. That actually did affect energy. But if we actually have a look at the S&P 500 chart, that's a brand new all-time high close in the 5200 region. Crazy when you think about that. And actually having a look at the IWM. This is the daily chart. So we're trying to break out from this zone. Not a 52-week high, still trying to break out there. Looking at S&P 600, very similar to the IWM. A little bit of a wick up here. Mid caps, this is a brand new closing high. If we actually have a look at the weekly chart, you can see not an all-time high in terms of wick, but a brand new closing high. We've never closed higher in S&P 600 mid caps. Very, very bullish on mid caps, as well as the S&P 500. That is a brand new close on a weekly basis as well as a daily basis. Very, very bullish. But let's actually dive into the S&P 500 on a more granular level. So we've got a very bullish candle right here. As you can see, we had a little bit of a wick at the bottom. The market was just having some price discovery down here. After 2:30, we got the FOMC, we got the economic projections, we got the dot plot. The market just absolutely rallied on the fact that we had only priced in 2 rate cuts instead of 3, as well as better than expected economic conditions for 2024. Now, hopping on the 5-minute chart, looking at, this is where we kind of opened. We sort of traded like this very, very tight range right here. And then when we got the economic projections, when Powell came out and spoke, we got a lot of volatility to the upside, closing at the 52.24 level. Very, very bullish. Look at this volatility intraday. That is absolutely nuts. So it goes to show that the macro does really matter and can move markets. Now, from a technical perspective, I've been saying it all week that the 50-90 area is the absolute line in the sand for the bulls and the bears. If they couldn't break this 50-90 area at this candle right here into the start of Monday, there's just no way they're going to break it this week unless we get like dire information about the market or just some really bad reports. But earnings are coming in good, and yeah, maybe we pull back to some lower levels, but right now I think the next level to watch is this level right here, 51.38. I think all pullbacks to this level right here should just be looked at dip buying opportunities to go ahead and actually continue breaking all-time highs in the S&P 500. But even then, with the strength of this market, we might not even pull back to the 51.38 level. We could be looking at stuff like 51.81 or even just like a clean 5200. If we do get pullbacks, very minor pullbacks into these areas, look at buying the dips right here, possibly right here. But for the most part, maybe we do like pass some of the losses tomorrow, maybe just have like a small correction. But I do think based on everything we've seen, it probably means we go higher, even to the 5300 level. And it's kind of crazy. My end of year 2024 target was 53.84, and we might actually hit that in the next couple of months, and that was my end of year target. So absolutely crazy market, guys. You don't want to fight this trend. As you can see, we keep making higher highs and higher lows on the way up to this trend. An absolute blockbuster rally we've had. We're bullish on the daily chart, we're bullish on the weekly chart, we're bullish on the monthly chart. Look at that monthly chart, absolutely crazy. This is a trend you don't want to fight. Now let's actually look at the RSP really quickly. On a weekly chart, that's a weekly all-time closing high on the weekly chart, as well as the daily chart, as you can see right there. Not a wick high. We might actually go ahead and tackle those wicks tomorrow in the RSP, but very bullish price action right here. This is the level we looked at on the weekend video, 162. We didn't even get there. We just kind of bounced, front run it, and now we're looking at higher price action here in the RSP. And this index, the equal weight index on a forward basis, I think still trades at about a 17 times. So very attractive even at these all-time highs. And it's actually probably going to go lower as we start pricing in Q1 earnings for 2024. Now the Fed didn't come out and say anything crazy. And that's simply because they know that they kind of need to cut rates at the moment. The 2-year is screaming at the Fed to go ahead and cut rates. At the same time, these 6 monetary policy rules right here are also recommending that policy rate should be reduced. And that's exactly what the Fed came out and said. Nothing we didn't know. Rate cuts are coming in 2024. The question is when. That's really the question. We can make predictions, market pricing in June, July, somewhere around then. But according to these 6 points right here, the midpoint target range, the Taylor rule, inertial rule, alternate range rule, forward-looking rule, each and every single one indicate that the Fed should cut rates. And that just means that policy is simply too tight. In yesterday's video, I went over the economy. The economy is doing really well, which means that rate cuts are needed to just normalize policy across the curve. And here's some really cool equity data I have for you guys. When rate cuts are done as a result to normalize policy, as you can see right here based on this green line, when we do get that first initial cut up to 2 years later, equities tend to rally anywhere between 40 and 60% here in the normalization category. So very bullish to have the economy sitting where it is right now and rate cuts on the horizon, because we need to normalize policy and not because there's a major meltdown ahead. Sure, there's like issues in real estate, commercial, offices, maybe some stuff with inflation that could get a bit scary in the future. But all in all, the economy is good and we're cutting rates to normalize policy. Now, let's switch gears, talk earnings. Guys, we're going to talk about Micron. Now, Micron are a niche semiconductor company. They produce computer memory, DDR4, DDR5 for both retail computers as well as data centers. I actually use Micron chips in my computer. I built my own computer. I use Micron DDR4. And let's take a look at their earnings. So Micron actually reported a blockbuster earnings, guys. Look at this. Earnings per share 0.42 versus a 25% loss. That's what the market was expecting on sales of 5.82 billion versus 5.34 billion. And they actually beat. This was a double beat and they raised. EPS was 0.38 to 52. The estimate was 0.2. Q1 revenue estimated was 6 billion. They're looking at the lower end of 6.4 billion range. And the market absolutely loved their earnings. You can see from the day's lows here in Micron is up to the peak in after hours 18.71%, and to be expected with the beat and raise they just delivered. Now let's actually look at the fourth quarter earnings 2023. This is blended earnings growth. 498 companies have reported. So the companies that have reported, we use their reported earnings, and then the companies that haven't, we use their expected earnings. And we can see here that blended earnings growth right now sitting at 10%, 13.6% excluding energy, 3.7% revenue growth in the S&P 500. Now this is a massive beat considering what EPS estimates were at the start of earnings season. Bottom up S&P 500 EPS estimates on the 5th of January, so when earnings season started, was for 3% growth here in the fourth quarter. We actually hit 10% growth. That's a 300% beat. And what does that mean for the rest of these quarters right here? I don't know, but we can actually talk about the first quarter and their estimates. So on the 5th of January, we were actually expecting 6% growth for Q1 2024. Now I have the latest data as of LSEG right here, as well as Pinnacle data, and Q1 2024 estimates is sitting at 5%. So we actually have seen a bit of a down revision. That being said, we're still looking at earnings growth at an 8.1% earnings growth in total, excluding energy. And the best sectors is simply utilities, comm services, information technology, as well as discretionary. They're all slated to produce double-digit earnings growth for the first quarter 2024. Even though 6% earnings growth was expected, and now we're only getting 5%. The market actually did price that in, because if you actually have a look at the earnings revision trend for 2024, this dark blue line right here, you could actually see that pretty much from like December into March, we did actually have a decline in earnings revisions, and a lot of that was for the Q1 earnings. So we moved from 6% to 5%, and that's actually a 15% decrease in earnings, and the market did sort of price that in, but we are starting to see a bottom form here in earnings revisions. And for the most part, excluding recessionary years, estimates historically hold up, and BofA do expect 2024 earnings to slightly increase for the rest of the year, and then 2025 earnings to come in at there as well. 2025 earnings have actually seen up revisions for the most part. So all in all, 5% earnings growth for this upcoming quarter, and if we can beat that very similarly to how we beat Q4 earnings 2023, the markets are going to continue to rally higher, and 5100 is going to be a thing of the past if those earnings do come in. Maybe not even 300% better, maybe just 50% better. Maybe instead of 5%, we get 7.5% earnings growth. That would be crazy, and that would lead to higher price action, especially if we do get stuff like rate cuts and a continued strong economy. Now let's talk sentiment with all of that in mind, with earnings in mind, with rate cuts, interest rate projections in mind. Let's actually have a look at FMS investor sentiment. We're going to tackle it across a broad range of questions. Now, BofA's fund manager survey, great data here. They asked FMS investors, what do you consider the biggest tail risk in 2024? 32% of investors said higher inflation, 21% said geopolitics. We actually saw a decrease month over month from Feb to March in the geopolitics answer, and then higher inflation actually ticked up. So fund managers, after the inflation data, getting a bit more bearish on the inflation front. That being said, 53% of FMS investors believe the biggest tail risk is geopolitics and higher inflation. Another question we got from the survey was, what is the most likely outcome for the global economy in the next 12 months? 62% of FMS investors in March said it was actually a soft landing, as you can see. 11% said the hard landing scenario, and then only 23% said the no landing. But have a look at what the sentiment was in January 2024 after the stellar earnings we've had, after the great economic data we've had. We've actually moved up to 23%. That's almost a tripling of fund managers thinking we're going to have either a soft landing or hard landing and moving into the no landing camp. At the same time, look at the hard landing camp in November 2023, December 2023, October 2023, sitting in the 20% to 30% range right here. That has now moved to 11% in February and March. Fund managers as a whole have become more bullish on the global economy, moving away from a hard landing stance into the no landing stance, into the soft landing stance. With that in mind, how are FMS investors positioned? Now this is overweight equities, overweight cash. Above this line, your overweight equities, below your overweight cash, and FMS investors are pretty heavily overweight equities, the most overweight since April 2021. And that is something to note. It does mean that fund managers are buying equities. And if history is anything to go by, we should actually see this slightly increase the higher the S&P 500 goes. But what exactly are FMS investors buying? Now in February, they bought the Eurozone, emerging markets, banks, and they sold the most out of US stocks, discretionary, and technology. So pretty much we're moving out of this like growth trade right here into more value names. And that's something I've been speaking about over the last couple of videos. I did think that we're going to have sort of like a growth trade. BofA also believe that we are in a recovery, and it does favor small size and value. And the Eurozone for the most part is actually just like value names. They're smaller size value names, and that's what FMS investors are buying, as well as emerging markets and banks. Now, moving down the aisle, they are also buying stuff like healthcare, Japan staples, and they're selling, utilities, industrial commodities. But all in all, in the month of February, fund managers were buying these, selling these. Now let's talk seasonality and stats. Some very interesting data right here. This is S&P 500 forward returns after a 0 to 2% drawdown in March. So we have a drawdown in March. What are the returns we can expect? The average return is about 3.2% in this period. So any drawdown in March should be seen as a buying opportunity, and you should have alpha within the first month. And in April, we actually normally have a gain of 1.6%, Q1 5.6, April to December 9.3, 12 months later 15.7%. And what does this tell us? Pretty much a dip in March actually provides very linear returns. You can see 2, 3.2, 1.6, 5.6% gain, 9.3% gain, 15% gain in that period. So you're getting very, very linear returns. if you do buy the dip in March. And these actually have very, very strong hit rates, anywhere from 80%, 85% and above. 12 months later, 9 months later, 87%, 91% of the time, the index will be higher. So any dips in March we do get, go ahead and buy the dip. Now, historically, we do actually get quite the dip in March during an election year. Price doesn't matter. What matters is the actual trend. You can see that we are in this choppy period right here. And normally around the April-March period, we actually can get a pretty vicious drawdown. And we are in this choppy period. And historically, we can actually look for a dip buying opportunity in March, although we may already have got it. That being said, just letting you guys know that we are in this average choppy period. And normally we are buying the dip for a very, very strong end of year run, particularly towards the November-December area, which can see gains on average of about 7%. And if you adjust for beta, I would say you're looking at double-digit returns based on the spread we're seeing in the S&P 500 in 2024. Now let's talk gamma. In this window of weakness, we continue to see a huge amount of positive gamma being built up in the chart. Negative gamma still remains a little bit elevated, especially here at the 5,000 strike and 4,800. But we actually moved and closed above the 5,200 line in the S&P 500, which probably means we're going to probably move up the tape here in the next couple of sessions. We're going to move up to 5,250 or 5,300, especially since we broke through this level. Normally, what would happen is if we do pull back, we'll use this core gamma strike as like a very strong support zone and then bounce from there and look to the other strikes as resistance zones. So 5,200 has eluded the market for a while. We broke through it. Very bullish when you look at that. Now we just got to look at where we move up to, 5,250 or 5,300 over the next few days. The gamma flip zone is still at 5,130 with elevated gamma pockets, at 5,000 and 4,900. However, we're in positive gamma. You want to buy dips, you want to sell rips, looking to higher price action, 5,200 and above now, especially closing above the 5,200 region today. Now, looking at market breadth, guys, something we're starting to see is that shorter term breadth metrics, look at 10-day highs, 20-day highs, is starting to tick up in a big way across plenty of sectors, particularly here, the energy sector, as well as industrials. We're seeing a lot in cyclicals too, but almost across all sectors, we're starting to see shorter term breadth metrics tick up. And that's really what you want to see. Well, after we've had a correction in time or even a little bit of a pullback, you want to see the shorter term metrics tick up, then the midterm metrics, and then the longer term metrics. Now, we do know the longer term and midterm metrics are sound. It's just we had a little bit of a pullback, last week, Thursday, Friday into early this week. And now we're seeing those shorter term breadth metrics tick up in a good way. We're seeing stocks and sectors retake 10-day highs, 20-day highs that they lost. And that's a really, really good thing. It means people are buying the dip. And this is constructively bullish for higher price action throughout 2024. So stay the course, buy dips, sell rips until further notice. Okay, let's have a look at some charts. Great chart right here. The risk on, risk off indicator for the long term. Currently, we are in a risk on environment. We have seen that risk on has sort of been declining ever so slightly, but all in all, we are still risk on. This means you want to be in equities. You want to hold equities, large caps, small caps, mid caps, a well-diversified portfolio of equities, and you don't want to play too safe. If we do get to the zero line right here, that's when you could start looking at maybe hedging your portfolio, maybe building some cash, stuff like that. But for the most part, it is risk on at the moment in the S&P 500. At the same time, this is the core market model. We're currently in the overbought situation. We hit extreme overbought. We did reject off it, and I think that came with the volatility we saw at the end of last week, start of this week, and we're now in this overbought level. This is not a bearish signal. It doesn't mean sell. This is actually very, very bullish. In this overbought territory, it means there's a lot of demand for stocks, and generally speaking, when we are in these periods of overbought, we generally go on massive runs in equities. Now, looking at University of Michigan consumer sentiment, now we've had a stark change in consumer sentiment right here since about July, October 2022 into 2023. And for most of 2023, we've seen an uptrend in consumer sentiment, consumers feeling much better about the economy and less pessimistic about the economy. And we're slowly moving into this 90 area, which normally when we do get into this area, we go on very, very strong levels, except when the government pumped $1.5 trillion into the economy right here, which artificially raised prices while the consumer Michigan sentiment was down. However, that's how the market works. And for the most part, this is really, really good. This means sustained longer term uptrends, healthier uptrends in the equity markets if consumers feel better about the economy. Now, this is the risk on, risk off ratio. It just uses this stuff right here, stuff like gold, copper, US treasuries, yen, the Aussie dollar, semiconductors, high beta stocks versus staples. Right now, it is risk on. You can see that we actually hit this resistance zone shown right here multiple times, then resistance turned into support, and this means it is risk on. The S&P 500 sectors above their 50-day moving average, 100% of sectors are above their 50-day. The same is true for sectors above their 200-day moving average. Very, very bullish. And on the longer term trends as well as medium term trends, this screams bullish, and any pullbacks we do get, you want to buy those dips because things are looking very healthy across the board, across all sectors and across all stocks. It's not just like situated in large caps, it's every single sector. So all in all, based on these charts that I've just shown you guys, longer term, everything is pointing to an active uptrend in the S&P 500, and any dips we do get here in March based on seasonality should just be looked as a dip buying opportunity, because these longer term metrics such as these and everything I've shown you today do point to higher price action in the future. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.